Following a two-day rout, can we find a firmer footing? Live from New York City this morning. Good morning, good morning. Your equity market positive, just about. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Ferro.
Live from New York City, we begin with the big issue. The post-Powell slide subsides.
Jerome Powell was very direct, very clear.
Now it's black and white. They're very aggressive.
Jerome Powell getting up and saying what he said, and boom, down goes all the speculation.
Everybody was kind of on the momentum trade. And
the interest rates of the Fed is just one element of the pricing of equity.
Now it's in the middle.
You have to be opportunistic. You have to be patient.
So far, there's been some resilience.
Valuations are more reasonable.
Short-term indicators getting oversold.
And corporate earnings have been resilient.
It's time to sit tight and react.
The market is giving you opportunities.
It's not a complicated game.
It's very, very clear that they want financial conditions to tighten considerably more.
Our advice to the institutional investor is to stay light and what I call light and tight.
Bullish? How about it could be worse?
It could be worse. Joining us now is PIMCO's Jerome Schneider, Eric Nelson of Wells Fargo. Gents, great to have you both with us. Eric, first to you, sir. Can you give me one reason to be bullish here?
John, it's hard to find one. Whether you look at the hawkishness from Fed Chair Powell and frankly other officials over the past couple weeks, you look at the European energy crisis. If anything, John, maybe positioning is one thing that maybe would help sentiment here. But from a medium-term perspective, there's a lot of challenges to get through, and it's pretty clear the Fed's resolve is quite strong for right now.
Fascinating to hear from Neil Kashkari of the Minneapolis Fed to Tracy Alloway and Joe Weisenthal on their Odd Lots podcast here at Bloomberg. He was happy to see the reaction after Jackson Hole. He said the following: I certainly was not excited to see the stock market rallying after our last FOMC meeting because I know how committed we all are to getting inflation down. Jerome, what do you make of that, to hear the quiet bit out loud?
Well, basically, I think that you have a situation where the, quote, successful Volcker disinflation is actually, becoming more permeated in the market. One of the factors, obviously, is that if you equate this to an automobile race, when they came out of Jackson Hole, what was really signaled was that the green flag wasn't being waved. So the need for risk assets was definitely not going to be waved into portfolios. The need for a checkered flag declaring victory on inflation was definitely not going to be waved. The race was not stopped, meaning the black flag wasn't waved, and nor was the last lap with the white flag. What we found ourselves in was with the yellow flag of caution, and we're going to likely end this race for a longer period of time. That means that this race will be finished under the caution flag for most investors. And so while you're looking, and many investors are looking for a reason to be bullish, really what we have to do is take a longer term view in terms of where that calibration happens. And that successful disinflation that Jerome Powell highlighted means that they're going to be on this course, as we know, for a very long time. In fact, I think one of the conditions we find ourselves in right now is that the tightening financial conditions that we've witnessed so far, although many people would believe that there's more to come, reality is that in calibration with what we've seen in the global financial crisis, we're seeing some of the tightest financial conditions now than we've seen since Lehman Brothers at that point in time. So there is some appropriateness to where we think the market is right now. And while there might be some deterioration to come, especially if you have growth deteriorate further into the later part of this year, we do need to be a little bit more cautious. Obviously, rates have been the massive recalibration element in that tightening process over the past few weeks.
Is a hard landing secured? Bank of America thinks so. They say this: the Fed wants to reduce inflation and will risk a recession to restore price stability. We expect a 50 basis point hike in September, though strong August employment could tip the balance in favor of 75. Eric, they say this: we continue to believe a hard landing is more likely. Do you agree?
John, it does seem like the most likely outcome at this point. You look domestically, and there's certainly a lot of risks building in the housing sector in particular. The activity there is slowing sharply, and it seems inevitable that at some point price declines will come. Labor market is holding up well, as we know, but that's a coincident indicator. We probably won't see that deteriorate for at least a couple months. What worries me the most, though, John, is the global situation. China, Europe, there really is not a sense of urgency in addressing the issues both in those economies, and at the same time we're seeing the dollar continue to strengthen. So the global situation is really deteriorating rapidly, and whereas that may have led to a Fed pivot in the past, it's really not seeming to do that right now. The Fed wants to see a stronger dollar to help that disinflationary story, and so the Fed really is firing on all cylinders right now, and that's going to continue to raise the risk of a hard landing.
And they want to see higher unemployment. That's going to be difficult to communicate once they actually get it. How do they convince people that this is a price worth paying to get inflation back down? Diane Swank of KPMG messaged me yesterday, and she said the following, and I think this is important. Park September. It's so much bigger than just September. She said this: the amount the Fed raises rates in September is less important than the direction and the resolve to slow economic growth below potential and raise unemployment. Jerome, how are you preparing clients for that moment when we start to see unemployment climb?
Yeah, we don't disagree. You know, I think one of the factors right now is that the Fed has made itself less data dependent, at least in the near term. And though while the number for this week, the jobs number, is probably important just to point somewhat of a trajectory, it probably has less dependency in terms of that tightening process along the way. Now, you are correct, and I think the possibility of increased job losses is something that is probably longer term. And I really think that this story becomes more profound in 2023 as we do see expect unemployment to start to increase closer to 4.5%, perhaps even 5% as we get into the latter half of next year. That is going to be a consequence that we have to deal with. But when you put all these things together, as noted previously, geopolitical risks, we have risks, obviously, in Europe as we approach the winter. We also have more structural issues with regard to capital expenditure, perhaps profitability, and those things will come. It will be an evolutionary process whereby the Fed doesn't necessarily have to pay attention to growth in the near term because some of the factors are actually quite positive. Still, job momentum is remarkably strong according to BLS statistics. But in the medium term, what we really want to do is focus on the fact that there could be potentially some deterioration as we enter into 2023. And actually, to be fair, John, we are forecasting a minus 1% year over year to end 2022 for GDP growth. It will flatline again back in 2023, but I think that just goes to highlight the uneven process of this healing, and that just simply picking your spot isn't necessarily something that's going to happen in the near term. It's going to be a longer race than people expect.
You're looking for some weakness in the economy. We've got some weakness in the equity market right now. We fade. On the session, we're up a third of 1%, but way off the highs of the session from earlier this morning. The S&P 500 up a third, the NASDAQ up a half of 1%. I mentioned those comments from Neil Kashkari, the Minneapolis Fed president, to our colleagues Tracy Alloway and Joe Weisenthal on their Odds Lots podcast. Citi responding to that and saying the following: Neil Kashkari is happy with the reaction to Jackson Hole, which included a significant sell-off in equities. His comments are likely indicative of broader sentiment on a committee that wants to see financial conditions tighten further. It's a clear negative for risk assets. Bloomberg's Mike McKee joins us right now. Morning, Mike.
Morning, John. Well, on the bond side, that's true. But on the equity side, you look at the futures this morning and you wonder what's going on. There are a couple of reasons why, according to analysts on Wall Street. One is doverai ni proverai, the old Ronald Reagan saying, trust but verify. Markets don't necessarily believe that the Fed will follow through and not cut rates next year. And some people are talking about that this morning. In some notes, you see, basically, it's what they didn't say. They didn't say we wouldn't cut rates in 2023, so it still could be possible. It's also a lot of vacation days piling up here. The last few days on the beaches out in the Hamptons, volume very low. And then we are, as you guys have been talking about, waiting for the August jobs and CPI. But look at this. This is the calendar for the month. And on the first part of the month, the first date of the month on Friday, we get the jobs report. And then we get the CPI report on the 13th. The decision comes on the 14th. That's during the blackout period. We will not know what the Fed thinks about the CPI. So you're going to see a lot of volatility as the markets try to figure that out. Right now, they are leaning towards 75. This is the median effective Fed funds rate. So what it's showing you is they think it's going to be about 3%, and that suggests just barely getting over the hurdle for 75. But that could easily change when we get those new numbers on Friday and on the 13th.
Mike McKee, does Chairman Powell have to dial 1-800 Mike McKee and get Mike McKee to come on TV and say this is what the hike will be? Or do you think the reaction function is fairly well understood now, that if we get a downside surprise on CPI, it's 50, upside surprise, and we're getting 75?
Well, it's going to be interesting to see, because it does seem the reaction function's in place for the jobs report. Get a strong jobs report, everybody says 75. For CPI, that's going to be a little bit harder to tell, especially if it's not definitive one way or the other.
Mike McKee, thank you. September 2nd, September 13th, in the diary. Mike, thank you. Got to factor in balance sheet reduction as well. Take a listen to Peter Cheer.
What I find most difficult to talk about is, if you go back to last summer when the Fed insisted on doing QE, they kept talking about market liquidity as the reason to do QE. I can guarantee you that market liquidity, especially in treasuries, is way worse now than it was last summer. I think we've already turned the corner on the economy in a negative way. We're seeing things roll over. And I'm willing to bet that by December, we're complaining about deflation and real problems in the economy rather than inflation.
That's Pete's call. Jerome Schneider, I'd love to get your understanding, to give us your understanding and help me understand what balance sheet reduction means for this market and for this economy.
Clearly, later this week, we're seeing that knob turned up, and we're going to see the full QT come into play at that point in time. Liquidity conditions are something that have been at the top of mind at PIMCO for, frankly, more than 3 years at this point in time, ever since the repocalypse of 2019. But the reality is that the factors for liquidity continue to evolve, not necessarily in a positive way. And we see that both in treasury markets and more broadly speaking. And part of the conditions now is policy measures, QT specifically, which are going to create implications with regard to broader market liquidity and, more importantly, broader market sentiments toward liquidity. So it's almost a self-fulfilling prophecy in a way that you might actually have liquidity become a concern because it's becoming more top of mind now, simply speaking. So when we see this happen and QT come into full force later in the beginning of September, this is going to be a factor for not only repositioning portfolios, more broadly speaking, but how to think about it. And this is exactly where portfolio managers like myself want to be thinking about transactional cost, how active management can come into play, et cetera. But in the longer term, I think what highlights here, Jonathan, is the fact that from an investor point of view, investors need to be more highly convicted toward the positionings they're taking, whether in risk assets like equities or even to fixed income, which has recalibrated pretty dramatically over the past few months, to make those allocations and take a little bit longer term view than the minute to minute, day by day, or even week to week allocations that we've become so accustomed to over the past 10 to 20 years.
Eric Nelson, final word here.
John, I think there's maybe a little too much focus on the QT as a direct impact on markets. Go back to 2018, Fed Chair Powell used the autopilot comment. We had a huge sell-off in markets. What really got the market lifted at that point was, I think, the pivot on rates. QT continued well into 2019, and really the market became much healthier through the early part of 2019. It wasn't until September 2019, when the repo market really imploded, that the QT pivot came, and the knock-on effects for markets weren't that big. So I think at the end of the day, the rates are really what matters here, and that's going to continue to be very restrictive for markets, for the economy, and lead to most likely more of a hard landing than a soft landing.
I can't believe that's already 3 years ago. I remember Jerome alongside me on the morning where things were getting really dicey. Jerome Schneider, Eric Nelson, sticking with us. Let's get you some price action. We're positive 0.4% on the S&P. Let's get you some movers. Here's Abby.
Hey, John. Well, similar to the major averages, we have lots of stocks moving to the upside, but off of the highs. One of them being Best Buy shares had been up as much as 5% earlier after the electronic goods store did beat estimates in a big way. Those were lowered estimates, though, so it's a lowered bar. Lots of interesting headlines coming out of their conference call, perhaps explaining why the stock is down to some degree, but they're talking about the idea that economic conditions, they're withdrawing for 2025 targets. Holiday shopping is starting later. They're doing more promotions. They're cutting some staff where needed for cost cutting. So a little bit of a cautious tone there weighing on those shares. ASML Holding, the semi-cap equipment company, up 1.2%. The TSM chief earlier was talking about shortages in chips. This is a company that will benefit as the company makes machines to make chips. Bed Bath & Beyond, well, the meme rally goes on. And of course, this company is providing a quote unquote strategic update tomorrow. Shares rallying ahead. And then Twitter, John, as you know, this saga simply goes down. At this point, the stock down a little bit here, down 0.6%. The bigger point, though, is it's well below, as you know, Elon Musk's original offer price of $54.20. Of course, Elon Musk lawyer sending a note through saying, a letter saying that the whistleblower suggests that his claims are more valid. The Twitter lawyer saying, no, not so much. This saga goes on. We'll be digging into it more later, John.
They'll battle that one out in court. Abby, thank you. We'll talk about that around the opening bell. Coming up, ECB officials clashing over the size of its next rate hike.
We should be humble about how the markets and the financial system responds to large rate increases.
Plus, Europe ramping up efforts to curb power prices. That conversation up next.
We should be humble about how the markets and the financial system responds to large rate increases. So if you're going to deliver the same amount of cumulative hiking in a given window, you can also make midstream corrections. There's more upside risk to inflation than downside right now, but there could be reversals on many dimensions where the terminal rate is not always going to be revised upwards.
The ECB debating the size of the next rate hike as the region braces for the latest read on inflation. This coming as Russia curbs more gas supply to the region. The French energy minister saying, quote, we're getting ready for the worst case scenario, which is a complete cut-off. The EU now planning on emergency intervention to prepare for winter. Team coverage starts right now with Bloomberg's Lizzie Burden and Gillian Lee in London. Lizzie, walk me through the big debate at the ECB.
Well, looking at economists' notes overnight and speaking to them as well, if they haven't already changed their call from 50 basis points to 75 basis points, they're probably thinking about it because of all those hawkish comments at the Jackson Hole meeting over the weekend, Schnabel, Rein, Villeroy, but also because of what Powell said. You know, the Governing Council can't ignore that the BOE and the Fed are making the ECB look behind the curve at this point. It's despite what Philip Lane said. You heard it there. He wants a steadier pace of rate hikes. He is, you know, very influential as chief economist. If economists are sticking with a call of 50 basis points, that's why. It's not really because of the inflation data that we had today. Spain declining from its record high in July, Germany rising in line with expectations. That's not really moving the dial, although, of course, we do get more data tomorrow.
If they can tell me what's going to happen with gas prices, I guess we can all tell them what they should do with interest rates. Gillian Lee, I've got no idea what's going to happen with gas. We're now talking about intervention. Gillian, do you have any understanding whatsoever over what that intervention is going to look like?
I think what they're going to try and do is find some way of delinking electricity prices from gas prices. At the moment, all the formulae link electricity to gas because gas is the marginal generation fuel. You've got your base load electricity generation that comes from nuclear and increasingly from renewables. And then you've got gas that provides to some extent, the swing between the peaks of demand either on a daily basis or on a seasonal basis. And so electricity is tied to that marginal generation fuel. What the European Union is looking at and what I think the UK government maybe will look at is how you break that link so that electricity prices better reflect the overall cost of generation rather than just that very high at the moment marginal cost of generation.
We'll see what the plan looks like when it comes together and gets confirmed. Gillian Lee with some insight there alongside Lizzie Burden, who ran away from the piano as soon as we said she might have to play it. I noticed that. To both of you, thank you. The euro right now, 100.25, and I think we're all getting a little bit more comfortable, even though it's uncomfortable, with the idea that this could go on for more than one winter. The Shell CEO, Ben van Beurden, saying it may well be that we have a number of winters where we have to somehow find solutions. He went on to say that this is going to somehow be easy or over, I think, is fantasy we should put aside. Eric Nelson, with that in mind, you've been looking for a weaker euro, you've had one. I look at all of this. I think of the prospect of it going beyond one winter, maybe 5. And I'm asking myself, not why the euro's down at parity, why it's not even weaker, why it's not collapsing given everything we're throwing at it.
Yeah, John, a big issue here is we're in the first or second inning of this crisis, and it's still extremely unclear what the economic impact will be, and we still haven't gotten there yet, right? A lot of the, say, the consumer measures that sort of aimed at limiting cost increases are set to take place in October. So, for instance, the UK energy regulator raising the annual energy cap or Germany's natural gas levy, these things don't take effect for a little while. We're just having seen the price increases in the past couple weeks. We haven't seen the knock-on effects on the industry in Germany. We're now starting to see some insolvencies at the utility level.
Yeah.
So the system is slowly starting to break, but we haven't seen it. And until we see the actual economic impact, we probably won't see euro break lower. But the key thing here, John, is positioning just is not as strong as people think. We still see more room for euro to go lower here.
The key thing here is that the ECB is willing to hike into this mess. Jerome Schneider, I've got 30 seconds with you. I wanted a final word with you on this. Did you ever think that you and I would be talking about a 75 basis point hike at the ECB?
Probably not. You know, I think my partners over in Europe are actually celebrating a bit now that we actually do have some positive yields in a way, although the winter is no cause for celebration in Europe. But I do think that what we need to be reflective here is one thing. We need to be looking the gift horse in the mouth, finally, around the world. And when you think about yields where they've been at the front end, both in Europe as well as the U.S., the opportunity set for investors is to accept the gift horse present and actually say this is a place to actually take some risk off the table and put some carry in portfolios and earn some income from the front end of the global yield curves.
And give Jerome Schneider a call. Seems to be the pitch there. Jerome, alongside Eric, to the both of you, thank you. Up next, your morning calls. Then later, Laurie Cavacina on why she thinks the June low may well be the low. Following a two-day rout in this equity market this morning. Good morning. This morning's price action struggling to stick. Futures positive just about 1/3% on the S&P 500. On the Nasdaq 100 up about 0.6%. Over the previous 2 days, the Nasdaq down about 5%. The S&P 500 down 4%. Brutal. Let's see opening bow, switch at the board and get to the bond market. That move fading as well. Yields look a little something like this. Now unchanged basically on a 10-year at 3.1062%. The euro just about stronger. Euro dollar positive 1/3% at 1.0030. Danske Bank looking for 75 basis points from this ECB next week. September 8th in the diary for all of us. Crude backing away down $3.20. We're off by 3.2% to $93.90. About 20 seconds into this one. Let's get you some movers. Back with us. Here's Katie.
Hey, John. Well, it's the opposite setup so far from yesterday's open. You have tech leading early gains. They're tepid, but they're still gains. Apple rebounding after just a wipeout yesterday, down more than 1.4%. Still 0.5% higher, not much to write home about. Nvidia also getting a boost. Chips broadly rebounding this morning, again following what you could call a wipeout yesterday and on Friday. Meanwhile, earnings season continues to roll on. You had Best Buy beat profit estimates this morning. Of course, that comes a month after the company cut its forecast, but still, it was a beat. You have shares 4% higher. Down at the bottom of the screen, you have Chevron falling from the bell as oil drops down over 3% after Iraq said it will keep pumping, John.
Energy, where the underperformance is, and Katie, thank you for that. You see that on the S&P, we're down about 1 percentage point. As an industry group, top of the pile right now, consumer discretionary up 0.8%. The S&P up about 1/3%. Drama, wherever Elon Musk goes at the moment, just not in the stock price of Twitter right now. We're down about 0.1%. Elon Musk citing a whistleblower claim in his most recent effort to scrap the $44 billion Twitter deal. The latest filing reading the following. These allegations, if true, demonstrate that Twitter has breached the following provisions of the merger agreement, thereby giving the Musk parties the right to terminate the merger agreement. Abby, are you up to speed on this one?
This is just incredible, John. And, you know, I think that we all had a sense back on April 14th when the bid by Elon Musk was originally made for Twitter at $44 billion or $54.20 that something might not stick. A lot of people talked about how high it was at that time. And now we just have the latest saga in this deal. Of course, that whistleblower last week, Twitter's ex-head of security, claiming all sorts of things around the company that they did wrong around privacy and other such issues. So Elon Musk's lawyers recently, as you just mentioned, raising this for another reason to terminate the deal. Twitter striking back, saying, no, we have not done anything wrong. This is not a reason to terminate the deal. Twitter at this point, to your point, down just a little bit. Tesla, another barometer on this deal, up just a little bit. But the biggest barometer, because of course, if this deal doesn't go through, folks think that Elon will have more room, more time for Tesla, is the gap. Follow the money. So of course, that deal price, $54.20, right now down below it by almost $15. So the markets are saying they don't think that this deal is going to happen. Or another way of looking at it, John, is maybe they think that it will happen, but at a lower price. And that was a lot of the speculation circulating back in April. And one other reason to think that maybe some sort of deal is going to happen, Elon has sold quite a bit of Tesla stock, basically 50 million shares, let's call it roughly $20 billion. We don't know exactly where he sold it, but he could be raising money in case he's forced to execute the deal at the $44 billion deal. Or who knows, John, maybe they do come up with a lower price. It does seem that Elon would like to have control of this platform based on the fact that he put in the bid, but maybe he regretted that price. So who knows? Maybe it will happen at a lower price.
Abby, thank you. April feels like a lifetime ago for all of us. Abby, thank you very much. Twitter down about 0.1%, a really marginal move. On the S&P 500, positive about 1/3%, call it 1/4% higher. The moves in the bond market have contributed to the volatility of the last few days, that's for sure. At the front end now, up 2 basis points to about 344. Yesterday we came very, very close to the closing high of the year, Taylor Riggs. We're starting to get a lift at the front end again this morning.
Yeah, another lift towards the highs that we haven't seen really since 2007. So that's certainly something that we're watching in the markets, and also that some Fed officials, too, are watching. I think it was interesting, Neil Kashkari yesterday talking a lot about sort of the equity markets as well, John, as we go cross assets, saying that maybe the markets are finally getting the picture. Maybe we're finally waking up, realizing that there was never a pivot. Maybe we made that up, and that the equity market falling is sort of signaling that we're finally believing that this is a Fed that is going to move and tackle inflation. That's sort of what you're seeing in the VIX. I would note that we've made a lot about maybe rising up to 24, 25. Nowhere near the 30, 40 levels of previous blowouts, but at least a little volatility starting to rise up. But again, sort of calmness, what does that mean? I think when we think about sort of the math of rates higher, we know that the pressure that puts on PE ratios. Some people are looking at the big drop on the right-hand side of that screen and saying that PE ratios have fallen. And in sort of the yellow areas, we've highlighted sort of the bottoming out of PE ratios of previous bear cycles. So we're not quite there yet, but we've certainly come a long way off from where we were around the highs of 2020. Finally, though, when we think about the bond market, maybe this is where we take our signals. Morgan Stanley, an interesting note, instead of looking at high yield, maybe we should be watching leveraged loans. Regardless of the market we look at, a bond market that's telling us maybe we're near bottom. We're actually closing down about 20% from some of the recent highs.
Was that Sri Sankaran over at Morgan Stanley? I think it was.
Yep.
Fantastic note. Taylor, just briefly, was it refreshing for you to hear Neil Kashkari say the quiet bit just out loud?
Ooh, maybe, because on our program, we had been talking about was there a pivot, was there not? And I think we finally got clarity. There was no pivot. We made that up.
We made that up. I think other people out there made that up. Taylor, not us, that's for sure.
And maybe the markets are finally realizing this is a Fed that's taking inflation seriously. How you value that then depends on how you think about the path of rates.
Taylor Riggs, thank you.
We don't make up anything.
As always, we don't make up a thing. Neil Kashkari, if you're just tuning in, this is what he had to say to our colleagues and friends Tracy Alloway and Joe Weisenthal in their Odd Lots podcast, which you should all take a listen to. I certainly was not excited to see the stock market rallying after our last FOMC meeting because I know how committed we all are to getting inflation down. He was happy with the reaction to Jackson Hole. I asked the question a few times this morning. If you're long, are you fighting this Fed? If you're bullish, are you fighting this Fed? Sebastian Page of T. Rowe Price said to us this morning on Bloomberg Surveillance, you are fighting the Fed if you're bullish. That's why a lot of people think the Fed put is now a Fed call. Lori Calvasina, though, she thinks we might not revisit this year's lows. Lori Calvasina says this: we think it's more likely than not that US equities saw their lows in mid-June. but have expected conditions to turn choppy again in the months ahead, with risk that the S&P 500 will retest its year-to-date low again in late 3Q. I'm pleased to say that Laurie joins us now. Laurie, I'm going to ask you the question that I asked T. Rowe Price's Sebastian Page. Are you fighting this Fed if you're bullish right now?
Hey, John, thanks for having me on as always. And look, I don't think we're fighting the Fed with our call of 4,200 at this point. And I want to remind everyone, strategists, most of us make that as a year-end call, not sort of an intra, sort of year high or low. But look, I think that the Fed at this point in time has said a lot of things that a lot of people who had been more critical of the market rally already understood, that the Fed was going to take inflation seriously, that the Fed was going to tolerate some pain. And I think in particular, the idea that they're going to we willing to tolerate some pain on the labor market is something we really have to dig into. And frankly, John, I look at the S&P. I also look at the Russell 2000. I think it's a very important barometer of market sentiment when you're in periods that are challenging economically. And what I see pretty clearly in the Russell 2000 stock prices is that they already baking in a material spike in jobless claims from here that hasn't happened yet. So, when we sort of think about the trajectory of stocks through the end of the year, we have about a 60% conviction that we saw the low back in June. Now, that doesn't mean we're not going to take another swing at it, that we're not going to see some additional volatility. But I think the market will be hard-pressed to really go too far below that at this point, just given what's already baked in terms of labor market pain.
A couple of things to unpack there. Let's start with the final point. And I'll try and make it really simple, and you can tell me what you really think. If we're already back at the June highs on a 2-year yield, Laurie, what business do we have being 10% higher in the equity market than the June lows?
Markets are looking forward. And I think at this point in time, the debate is really not over what kind of economic damage we incur in the back half of this year. Obviously, we'll pay attention to that. But I think the debate, when we think about how markets are going to trade in the fourth quarter of the year, is really what is the setup for next year. And if you think that we are going to have some sort of recovery, even if it's a tepid recovery, I think that markets do deserve to sort of trade back a bit from those lows that we saw in June. If we end up sort of tipping into a second half of 2023 recession, a mid-2023 recession, I think that our 4,200 call is probably going to end up being wrong. I think you have to make a call on whether or not we incur most of the damage over the next few quarters or if it gets pushed into late next year. And my sense is that it's more of a near-term issue than a longer-term problem.
Interesting. That's a split with you and Chris Harvey of Wells, because he thinks maybe the first half of 23 is where we start to see the damage. Mike Wilson's Morgan Stanley's Mike Wilson is expecting to see that pretty quickly in the second half of this year. Laurie, the other piece that I wanted to pick out here is just on small caps. It's something you said just a second ago, and you said it in your note as well. The equities in the US are more interesting through a small cap lens. Can you build on what small caps are pricing and what large caps aren't?
So I think that small caps have done a little bit more of the work in terms of pricing and some of that deterioration in the labor market. And I think the reason why is if you look back historically, small caps usually make a big pivot and start to outperform large caps again once the unemployment rate starts to tick up in the middle of recession. So I think small caps, frankly, are just more attuned to the labor market trends that are coming as opposed to the ones that we've been living in the past. I think the other things that small caps capture very well is differing views on the economy by geography. If you look at current positioning in Russell 2000 futures, they've actually been below financial crisis lows in the future market. If you look specifically at the asset manager group and the CFTC data, think about that for a minute. The sort of domestic bucket in the U.S., people have put on these massive net short bets, and they're worse than what we saw at the heart of the financial crisis. So the pessimism on the U.S. economy expressed through small caps is already pretty severe. But I'll tell you, John, what I've been hearing from investors as I've been out on the road in August is everyone's worried about Europe, whether it's through mortgages, whether it's through energy prices, and the U.S. is viewed as a safe haven to some extent. And when that ends up happening, U.S. equities do funny things. They end up not being hurt as badly as people would normally expect. And you do tend to see small caps be the big beneficiaries of that kind of domestic trade.
Laurie, have you managed to find an equity bull in your conversation with clients? I keep asking that question this morning.
It's a great question, John. I actually got asked this in my last road trip. And what I told people was, it's sort of similar to what you see on CFTC data on asset manager future positioning, which is, sort of ticking up for equities, but still very, very low versus history. I'd say my conversations, it's about 85% pairs, 15% bulls. I do feel like that 15% has grown just over the last month or so.
Interesting.
And what those people in that the people in the 15% category, they're not making big market calls, but they're saying, look, I don't know what's happening with the market, but I do think there are interesting bits and pieces to pick apart.
Everyone's bearish, and for some people, that's reason to be bullish. Laurie, I know you've got thoughts on the midterms and the conversations you've had with clients as well, so let's do that next. Coming up, The Biden administration defended the Fed's efforts to rein in inflation.
He gives the Federal Reserve their independence to make the monetary decision on how to deal with inflation. We believe they have the strongest tools to deal with that. But we know that Americans are feeling the pain of higher costs, higher prices.
We'll see if the mood changes if unemployment starts climbing. A conversation still ahead.
He gives the Federal Reserve their independence to make the monetary decision on how to deal with inflation. We believe they have the strongest tools to deal with that. But we know that Americans are feeling the pain of higher costs, higher prices. Our goal is to keep bringing down inflation without sacrificing the historic and life-changing economic gains that we have seen this country has made over the last 18 months.
The White House defending the Fed following Senator Warren's latest comments. This coming as President Biden gears up for a primetime speech this week ahead of the midterms down in D.C. Here's Emily Wilkins. Hey, Emily.
Hey, John. So, yeah, it's very interesting. The White House really coming out yesterday defending the Federal Reserve and their aggressive hike in interest rates. This comes as you saw just a few days before Democratic Senator Elizabeth Warren coming out and criticizing the Fed for their move, saying that she was worried that it could lead to high unemployment. Certainly, inflation, it is a major concern for the White House. It's the main thing that Republicans are latching onto as they make their pitch to voters in November. And it really is. I mean, I've talked to Democrats, I've talked to Republicans who have been out there on the campaign trail. This is coming up for voters. It is a big, big issue on their mind, and it's going to be a big issue going into November. At the same time, Democrats, they're not necessarily trying to shy away from addressing the economy. You've heard Biden really tout the low unemployment, but you're seeing them now talk a little bit more, go on the offense, talk about Republicans and sort of try to paint them as a more extremist party. They try and tie this to things like the recent abortion ruling, anyone who supports a ban on abortion. They talk about those who still say falsely that the 2020 election was stolen. So expect to hear some of those elements when President Biden speaks in Philadelphia on Thursday, and expect to hear those from Democrats really across the spectrum to some degree. You're going to see a lot of Democrats kind of pointing at their Republicans opponents and saying that they're a little bit too aggressive, that they're a little bit too extreme. But at the same point, again, this is a pitch Democrats are trying to make as they're trying to push back against historic inflation, which, you know, it's the party in power that always gets blamed, and it's Democrats that are being blamed right now for the high prices we're seeing at the grocery store, in mortgages, in rents, and still at the gas pump. It's come down, John, but it's still high.
The good news is that unemployment is 3.5%. The bad news is that the Federal Reserve, for many, many economists that come on this program, are looking to get that higher to get inflation lower. And there seems to be a disconnect between the Federal Reserve's objectives and the goals of this administration. And when Karine Jean-Pierre, the White House press secretary, said the following, "We don't want to step on what the Federal Reserve is going to do," that makes sense for now. But when they tell me our goal is to keep bringing down inflation without sacrificing the historic and life-changing economic gains that we've seen this country has made over the last 18 months, Emily, isn't there a disconnect between what is about to happen with this labour market if the Fed is ultimately going to be successful here on getting inflation down?
I think you make a great point, John, and we've heard that mimicked by a number of economists who've said that, you know, this is part of cooling the economy by aggressively raising these rates. I think to a certain extent, there's always a certain degree that yes, the White House, the person in charge, is making decisions that have an impact on the economy. But I think, as we've also seen, there is a lot that the Biden administration really does not have control over right now. To a certain extent, this is a game of messaging. This is a game of narrative. This is trying to predict what's going to be happening next and then kind of get in front of that. So I think there are really just a lot of questions between now and November, and we're really going to have to keep a very close eye on what the markets do, on what happens with inflation. Certainly, those are numbers that are being monitored very closely by the White House.
By all of us as well. Emily, brilliant, as always. Emily Wilkins down in Washington, just setting the stage for the big debate in Washington ahead of the president's address later this week. It's slowly creeping on the horizon, and coming onto the radar of many investors as well. Laurie Calvasina of RBC had this to say. US equity investors were anticipating a strong showing for Republicans in the midterms as the summer got underway, which contributed to the summer rally in the stock market. But the data has been telling us that risks to this consensus view have been growing, which we have viewed as a likely source of volatility in the coming months. Laurie's back with us. Laurie, a number of months ago, it was going to be Republicans take the Senate, they take the House. Now the view is a little bit more mixed. Why does that matter?
It matters, John, because when markets were coming off the lows in June, one client meeting after another, they were shoving charts in my face of the midterm elections and how stocks usually bottom in October and rally through year end. And even though investors were deeply bearish, they were getting excited about that. So that was one of the big reasons, in my opinion, that stocks had that fierce move in July. And I think going forward, we all know that markets react as much to rate of change and shifts in direction as they do levels and outcomes. And I think there's plenty to worry about in the data. The polling data is shifting back in Biden's favor. If you look at how gas prices have come down, that seems to be helping him for now. If you look at the generic congressional ballot, we're starting to see the Democrats look a little bit better than Republicans there. That's a recent shift that's sticking. If you look at the betting markets, which I know a lot of people think are garbage, but a lot of people on Wall Street watch them anyway, they're now anticipating that the Democrats are going to stick the Senate or keep the Senate, and you're actually starting to see some movement in the House race, which is still expected to go to Republicans, but the Democrats are starting to make a move in that poll as well. So I think the data is really starting to shift and highlight that the kind of news flow that's shifting in Democrats' favor a little bit, it is showing up in the data. I think this is still going to go Republicans' way for at least one chamber in the end. That should help us in the fourth quarter. But between now and then, it's just another excuse for markets to sell off and people to take some profits.
Well, right now, we're fading on the S&P 500 by about 1/10%. On the NASDAQ, we're now unchanged. Laurie, we started the conversation about whether we're going to retest the June low. I want to finish the conversation there. Strategas had this to say on this very debate. The greatest risk to the economy and markets may be the Feds need to tighten more than risk markets anticipate. Market bottoms are usually associated with lower earnings multiples, a higher VIX, and a blowout in high yield spreads. We've not seen that yet. Laurie, just as a final word, what would you say back to that?
Look, I think that those are definitely relevant issues, but I do think that the biggest risk we have right now is that we talk ourselves into a deeper recession than we necessarily have to have. And so I think the pivotal thing to be watching in the coming months is corporate reactions to what's been going on. Corporate reactions are going to be seen in conference season right after Labor Day. We're going to see them in earnings reporting season too. But I think really all this is going to come down to is how many jobs companies decide to cut. I'm optimistic that they will not cut into the bone, just given how tight the labor markets have been. We obviously know that's all trending in a negative direction. I think the market can handle some cuts. Can they handle severe cuts? Probably not. And I think, to me, that is really the biggest risk we face in the back half of the year.
Laurie Calvasina of RBC. Laurie, love catching up with you, as always, just breaking down some of these big issues and also talking about midterms and the political consequences of that for the first time. Here's some news for you from Reuters. Taiwan's military fired warning shots at a Chinese drone. The first kind of headline we've seen like this since all of this really started to get going when Speaker Pelosi visited. Taiwan's military fired warning shots at a Chinese drone, according to Reuters. That headline coming out moments ago. Equities fading. I brought that up a moment ago. I'll do that again about 23 minutes into the session. We're down about 1/10% on the S&P. The real underperformance coming from energy, down about 3.6%, largely reflective of what's happening in the commodity market. Crude lower by 4.6% on Brent, just above 100 at $100 and about 23 cents. WTI fading by 4.5% right now at 92.66. Up next, your trading diary, live from New York. This is Bloomberg. We are about 26 minutes into this session, and 2 days of losses becomes 3. On the S&P, we're down a little more than 1/10%. The NASDAQ struggling to hold on to gains, pretty much unchanged on the session. That's the price action. Let's get you to the trading diary. US consumer confidence and JOLTS data at the top of the hour. Fed President Williams speaking at 11 a.m. Eastern, followed by President Biden, 3:15 this afternoon. European CPI and remarks from Fed President Mester on Wednesday. The highlights are Thursday, ISM manufacturing and initial jobless claims. Then on to Friday. It's payrolls Friday in America, looking for something in and around 300K. From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.